Welcome back to the class. In today's session, we are going to explore one of the most foundational pillars in the world of accounting and financial reporting, the conceptual framework for financial reporting. The framework. What exactly is the framework? If you understand this framework clearly, you will be able to understand the logic behind IFRS standards. Why? Certain accounting treatments exist. Why do certain accounting treatments exist? And how professional accountants make judgments when there is no specific standard available. This lesson will break down the framework in a simple step by step real world manner. All right. So, what exactly is the framework? Think of the conceptual framework as an instruction manual. All right. Instruction manual or the blueprint, right, on which the entire financial reporting world is built. All right. So this is a kind of instruction manual or a blueprint where the entire financial reporting world is built. It is created and maintained by IASB. IASB stands for International Accounting Standards Boards. International Accounting Standard Boards. Just like a building needs an architectural plan, IFRS needs a conceptual plan. This is a conceptual plan. All right. This plan provides the rules, principles, and the logic behind every standard. Right? Why do we need the framework? What's the purpose? What is the purpose of this framework? Now let's understand why this framework exists. What's the actual purpose? The framework serves three main purposes. All right? Three main purposes. First one is to guide the IASB. When IASB develops new IFRS standards or updates the existing one, they use the framework as the foundation. It ensures consistency, logic, and clarity. All right. And the second one is to guide companies and accountants. What? Sometimes IFRS standards may not clearly cover a specific issue. Right? In such cases, what happens is accountants refer to the framework to choose the most appropriate accounting policy which suits the particular scenario or situation. Right? And the next one is to help users understand IFRS better. Okay. Students, analysts, investors, and the auditors use the framework to interpret IFRS correctly, understand better. It acts as a reference book for understanding the why behind every accounting rule. All right. What is the objective of financial reporting? Objective of financial reporting, let's simplify this. Okay. The main objective of financial reporting is to provide useful financial info, to provide useful financial information about the entity. What does that mean? So that existing and potential investors, lenders, and creditors can make decisions about providing resources to the entity. This includes decisions like should I invest my money? Should I give a loan? Should I extend credit? Is the business profitable and stable? These are question marks. Okay, so the entire purpose of financial reporting is to serve these decision maker, to serve these decision makers. All right. And qualitative characters of useful financial information. What are the characters? Characteristics. Now imagine you are buying a business or investing in a company. You need information, right? To buy any company, you need a lot of information, whether it is numbers or annual reports or whatever. But not just any information. The information must be useful. Useful info is the primary requirement. right? To analyze a business, or if you want to buy a business, the conceptual framework identifies two types of characteristics that make information useful. What are those characteristics? First one is fundamental characteristics. Fundamental characteristics, right? What's the second one? The second one is enhancing enhancing characteristics, right? So what's the difference between these fundamental characteristics and enhancing characteristics, right? There are subcategories in this fundamental and enhancing as well. In fundamentals, there is one thing called relevance. All right, information is relevant if it can influence decisions. For example, current profit, future cash flow, and risks are all relevant, right? The second one is faithful representation. Faithful representation. Information must show the reality of the reality of the business, not overstated profits or understated liabilities. This means complete, neutral, free from error. Even if estimates are used, they must be realistic and unbiased. Okay. Where comes to the enhancing characteristics, right? These improve the usefulness of the information. How? So comparability. These compare across companies and time period, so that you can use the information better. Okay. Verifiability, timeless timelines, and understandability. So verifiability is independent people can confirm the information, right? Timelines, information must be provided on time. Where comes to understandability, it must be clear and easy to interpret. Okay. So these qualities ensure that financial statements are not just accurate but also practical for decision making. Now we can get a little bit more deeper. Let's get into the elements of financial statement, right? The elements of financial statements. What are the elements? Basically, the elements are assets, liabilities, and equity. There is a formula called assets equal to liabilities plus equity, right? You, you might have learned it in your 11th and 12th, right? And there is something called income and expense. So these are the elements of financial statements. Okay, for each of these elements, the framework gives, what does the framework gives? Definition and recognition criteria and measurement principles, right? This helps accountants know what to record, when to record, and how to value different items. Okay, for example, revenue recognition. How do we recognize the revenue? So basically, when it comes to sales, so if we have received the cash, then it is a sale. Sometimes even when we don't receive the cash, it is considered as sales according to IFRS. How? Because we have done the sales in credit. In the income statement, the credit sales are also considered as sales, even though we did not receive the cash yet. The cash is going to be received in the future, still we have considered it as a revenue. So this is an example. Okay, moving on. Recognition and measurement principles. This is where the framework becomes extremely practical. Recognition: an item is recognized in the financial statements only if it meets the definition of an element, it is useful and relevant to the users, and it can be measured reliably. For example, you can recognize a brand created internally because you cannot reliably measure its value, right? When it comes to measurement, assets and liabilities can be measured using methods like historical cost. You might have heard it in the intermediate. Current cost, fair value, present value. We will do all these concepts in the future in the coming classes. All right, don't panic. Every concept is dealt with. I have made videos on each and every topic in this series. Not only in this series, coming classes we will have management accounting, next financial reporting, financial management, and audit and assurance, many other subjects. Each and every exam, each and every subject I have covered detailedly in every video. All right, every exam has a playlist, so don't panic. Keep following the playlist, watch every single day, so that it's not overwhelmed. All right, so the framework explains which, when each method is appropriate, right? Now there are some important topics here. The accrual and ongoing concern concepts. What exactly is accruals, right? Accruals. Accrual concept is we record a transaction when they occur, right? When they occur, what does it that mean? Not when cash is paid or received. For example, sales made on credit is considered as a sale, although cash is not received yet. Cash is going to be received in the future, right? Example is sales on credit. And what else can you think of? Expenses incurred but not yet paid, right? Expenses incurred but not yet paid, right? So this gives a more accurate picture of performance. Now what's going concern concept? Financial statements are prepared assuming the business will continue operating in the foreseeable future. Okay, when we prepare the financial statements, we obviously thinking that this business will exist in the future. If if we do not have any confidence that after 2 years we're going to shut down, or we are going to liquidate the company, why do we bother of doing the financial statements? Although we still have to present the financial statements because of the rules, but going concern concept tells you that financial statements are prepared assuming the business will continue. Okay, we are assuming the business will continue in the future, operations in the foreseeable future. If a company is about to shut down or liquidate, the entire accounting basis changes, right? So that is there. Okay, so and the we are going to deal with the last second concept, that is prudence. Prudence is a very important concept in financial reporting, right? Prudence. So sorry guys, my internet is a little bit slow. Okay, so we were talking about prudence, right? Prudence, right? Prudence is being cautious, being cautious when making judgments under uncertainty. It ensures that assets and income are not overstated and liabilities and expenses are not understated. That means the numbers should be right. Okay, the numbers should be right. Assets and income are not overstated. If they are overstated, people believe that this company is making abnormal profits or whatever, and they'll start investing more, right? Many companies, not many companies, some companies does this, like Satyam scam, uh, some other people did it in the past. Like they show the profits more. What happens, that's not a real profit, that's a fake profit. They manipulated the income statement, financial statements, to get to that conclusion, right? They understate the liabilities so that investors think that the company is uh, profitable and we need to keep investing more money, right? So if there is a chance of losing a lawsuit, we must provide it, recognize a liability if there is a chance of losing the money in a lawsuit. For example, some employee filed a complaint or filed a lawsuit, some other company filed a lawsuit, and your lawyer said that there is a high probability that you're going to lose the lawsuit. So in this case, in this particular case, we have to definitely recognize a liability. All right, But if there is a chance of winning a lawsuit and receiving money, we do not recognize the income like we did in the liability income until it is almost certain. Prudence protects the users of financial statements from overly optimistic assumptions. So the next one is capital and capital maintenance. Concept of capital and capital capital maintenance, right? Basically this is not in the FA syllabus, all right, but the book has mentioned it, that this is not in the syllabus and they have still mentioned it, like a quick reminder. So these concepts explain how a business determines the profit by maintaining the value of its capital, meaning though not examinable here, it is a part of the full framework. Okay, so don't worry about this concept at the moment. Okay, so the so overall the summary is, we covered the entire conceptual framework in a very structured way, right? What it is, why it exists, objectives of financial reporting, qualitative characters, right? And recognition and measurement elements of financial statements, right? And accrual and going concern, prudence, capital maintenance. Understanding this framework is essential because every IFRS standard is built on these principles. Okay, so